We got to get down to business. What's happening, future certified public accountants? Thank you for joining us. Yes, this is going to be a fun event, but we got some serious business to do. We need to get you through the exam, and we're strongly suggesting, obviously, you get BEC out of the way in 2023. So 2023 is for BEC, you and me. We're going to knock it out. My name is Peter Olinto. I'm one of the lead instructors here at UWorld and very grateful for the opportunity to be a part of their team. I've been a long admirer of Roger Phillip, who is amazing. So I'm glad to be a part of his team. Real quick, my background, yes, I'm a CPA, but I'm also a lawyer and a charter holder, CFA charter holder. But the good news is I'm not all that bright. So you just got to ask my friends who I went to high school with. So if we had a two-tailed distribution of the IQs on this call, I can guarantee you my IQ would be in the left tail. The difference between success and failure, CPA, bar exam, different levels of the CFA, is the time and the effort you put in. So if you're looking for some kind of shortcut, a shortcut is a recipe for a 72. What I'm about to do is show you how to work hard, but work smart. So obviously you want to put yourself in the best position to succeed. The BEC exam you're going to see is about 100 hours on average to prepare for, okay? I'll talk more about that in a second. So look, what do you have for me? Do you have 20 hours a week? Because you're talking about 5 weeks. If you're saying, Pete, I got 10 hours a week, okay, you're looking at 2.5 months, but you can and will do it if you're willing to make that sacrifice, that serious commitment. So look, part of your study plan, I don't know what you were going to do tonight, but here's your assignment. You need to talk to your significant other, husband, wife, boyfriend, girlfriend, whoever it is, and let them know you're going to shut it down so that you could properly prepare for the BEC section of the exam, and they need to support you during this endeavor. If they give you a hard time during that period of time, listen, let them go out and find somebody else, because after you get the CPA, you'll be making so much more money. Chances are you'd upgrade anyway. Come on, you got to be kidding me. They got to support you. I was dating somebody at the time I was studying for the CPA. All you ever do is study. You're a boring account. I was like, do you think on a Friday night I want to go to the library and study consolidations? Is that what you think I want to do? Because I'm hoping on the drive over to the library, my appendix bursts so I can go to the emergency room instead. It's not what we want to do. It's what we have to do for a short period of time. So be willing to make the commitment. Now, look, if you're going to study 20 hours a week, I don't want you doing that on the weekend. That's no good. You got to be active pretty much every day, 6, if not 7 days a week. So if you said to me, Pete, I'm going to study 20 hours, I'd like to have you get up for a short period of time, short period at 4 o'clock in the morning for a short period of time and study till 6. And then you start your day like you would otherwise. And don't tell me you need sleep. Go watch Band of Brothers, World War II. These dudes weren't sleeping for like 2-3 days at a time. And when they did sleep, they slept for like 2 hours and people were shooting at them. Nobody's shooting at you. So I'm not a morning person. I swear I'm not. But for a short period of time, 2 hours Monday through Friday, and then you'll do the bulk of your studying 10 hours or so on Saturday and Sunday. Look, you can't tell me you're going to study, hey, Pete, I'm going to study 20 hours 1 day a week. Law of diminishing marginal returns. If you're trying to study more than 8 hours a day, I can guarantee you in hour 6, 7, and 8, you're not getting much of a return on that investment. So let's spread it out. The other thing is, don't talk to me about studying in little short increments and all this crap that people try to sell you with their nonsense. Look, they don't let you take the CPA exam in short little increments. It's not like you study for a half hour or you take the exam for a half hour and then you say, oh, I'm tired, I'll come back tomorrow. No, don't work that way. Mental endurance. You can't get a single question wrong exam day because you're mentally fatigued. I need you sitting down 4 hours uninterrupted, studying, watching the lecture, working questions, but you've got to train yourself to sit down 4 hours uninterrupted so you can bang this thing out. Slow and steady wins the race, folks. Some of this is math intensive. My suggestion is order in which you study. There are certain things, corporate governance, enterprise risk management, a lot of the IT that, look, there's a lot of memorization involved. It's a lot of theory, a lot of terminology. It's not a heavy lift, but there's a lot of information. But you don't want to read it, reread it. Don't study that on the front end. Look, if you're pressed for time, if you study that on the front end, and you memorize a lot of crap, and then we start doing the corporate finance and the cost and the managerial and the the econ, you're going to forget all that stuff. So start with the math intensive. Hardest ones in, first ones out. Let's get the hard content, the math intensive on the front end, and then all the crap you got to memorize. You need it fresh exam day. It's got a relatively high point value, but it's not like you got to memorize it on the front end, do the math stuff, and then on the back end, you have to then revisit all that stuff. So the order in which I would suggest math intensive first, leave the theory items on the back end, okay? It's not that heavy of a lift. Let's see, what else? You know, some topics, corporate finance, and you know what? Yeah, you could switch over. I'm sorry, I'm going on and on. I'm a little bit excited. Madeline, can you tell I'm a little bit excited? This is my first presentation for UWorld, man. It's a whole new UWorld. All right.
See,
So
we're all excited. We're all excited.
all right, good, sweet. So the overview of what I'll be discussing in this 1 hour free seminar here, which by the way, our goal is to earn your business, because we're going to have another free seminar in September where I'm going to be doing problem solving for an hour for free on the heavy hitting math intensive topics. Okay. But we want to talk to you about why you want to get BEC out of the way first, a little bit about the blueprint overview. I'm going to work some practice questions with you to kind of illustrate what my boot camps, our boot camps at UWorld are going to look like to help you get prepared for BEC. And that's the most important thing here today. We'll talk about some key dates to make sure you don't miss the registration deadline, which is dependent upon the state you're in, and then the last date you have available to study for BEC. And then on the back end, for about 30 seconds, I'll take questions. No, I'm going to try to save 5 or 10 minutes on the back end to take questions. But look, if we can't get to it today, you're going to email them in. My buddy Madeline, the whole staff of UWorld will be answering your questions offline, so don't sweat it. All righty, Madeline, next one. All righty, so why BEC? Yeah, you know me, because you don't want to sit for discipline unnecessarily. You know the change in format for the exam is such that you're going to have to, for people who haven't passed BEC, well, you know what? You got to take one of these disciplines, which is kind of going to be the highest level of difficulty, so to speak. The core concepts I'll show you in a second, you know, kind of like the intro, the intermediate level of difficulty. But man, the disciplines are going to be challenging. That would be the equivalent of the more advanced accounting or the tax 2, etc., as you're going to see. So why not get BEC out of the way so that it equates to one of the hardest parts? One of the great things about BEC, historically, the pass rates have been higher because not that the subject matter is all that much easier, there's just less of it. Current format for the CPA exam, if you were to look at the volume of information in BEC relative to the other 3 parts, BEC tends to take the least amount of time to study for because it tends to have the least amount of information. So it has a lot of value going forward if you can get a discipline for the effort of a BEC studying. Listen, if you are around the world and English is not a first language for you and you're worried about the written communication, I have to tell you, you might want to think about then foregoing BEC. Now, this is an exception for anybody who's very worried about the written communication because you struggle with English, you haven't been educated in that's not your first language, you're not accustomed to writing essays. That might be causing you a lot of stress. Well, the good news is that'll be going away in 2024. So that's counter everything else I'm saying, but that's a very small percentage of the people on this call. Most of you, if English is your first language and or you're accustomed to writing essays in English, the written communication is not a big deal at all. As a matter of fact, you're going to watch the way we set these things up. It's not about memorizing information to write like in college, or I got to express what are the elements of a, it's not like that. It's can you explain things, you know, in a memo to a partner, a manager, a coworker, a client. What's the issue? What's your rule, your analysis, your conclusion? You're not going to be using any LOLs or any of that crap. So it's really not that hard for most of us, except if English is not your first language, okay? So for the most part, English speaking, not going to be a big deal. Next slide, please. So as I was mentioning, going forward, you guys know this, I'm sure you've seen this, beaten to death. You don't lose credit for anything you've passed. So if you passed audit, you get credit for the audit core, you pass financial, blah, 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 blah. So relatively speaking, you know, it's almost, you know, a good exchange, kind of, sort of. Like, I will tell you that there's an advantage to sitting for financial in 2024 versus 2023. Because there are certain heavy hitting topics that are in 2023 financial that in 2024 are not going to be in the new financial because they're being moved to the bar. That's right. You got to go to the bar, have a couple of drinks and take some of those topics like the governmental accounting, etc. So actually the financial in 2023, if you ask me, just given the volume of information, is going to be more challenging than the financial in 2024, which is more evidence that you should sit for BEC for the most part in 2023. leave financial, etc. till 2024. But the BEC, you can see the value. The bar exam is going to be a combination of cost, managerial, a lot of financial. You've got your IT stuff in the TCP, then obviously, in your IT section, ISC, and then your TCP is going to be for the people who are going to be tax professionals. So, it is what it is, but if you can get that out of the way, and you might say, Pete, I'm going to be a tax professional. Well, you know what? Take CPE classes. Get the damn CPA exam out of the way. If you want to enhance your knowledge for work, you could take course-specific information at the request of your firm. You ask them, hey, what do you think I should take in terms of CPE to be a better employee here? That'll probably do a lot more for you in your future than necessarily sitting for the TCP section, okay? So get BEC. Next slide, please. In terms of the format, folks, you could see the number of multiple choice here. So 5 testlets like every other section of the exam. First 2 testlets are your multiple choice. You can see that's 50% of your exam. Be mindful, folks. Pre-test questions. You're talking about approximately like 10 questions of those multiple choice that don't count towards your score. So the moral to the story is, man, you've got to make sure when in doubt, you guess and move on. God forbid you spend 4 or 5 minutes on an individual multiple choice. Best case scenario, you spend 4 or 5 minutes, it counts towards your score. Great. But you know what I can guarantee you? You spend 4 or 5 minutes on an individual multiple choice, your heart's going to start to race, and everything thereafter that would have been relatively easy becomes progressively more difficult because now you're starting to rush trying to make up time, and now you start making silly mistakes. On average for the multiple choice, you have exactly 1.94 minutes, approximately 2 minutes a question. But some are designed, as I'll show you, to be answered in 30 seconds because others might take 3 or 4 minutes. But don't take a 3 or 4 minute math question, you solve it, you don't get one of the answer choices and then do it again. No. You're going to pick your favorite choice there and you're going to move on because, like I said, you spend too much time and then God forbid it doesn't count towards your score. You can't have that happen. Obviously, you have your task-based simulations. So your task-based simulations there, certain things lend themselves well to math-intensive task-based simulations. I'll show you one of those today, what that might look like. But legalize cheating. So when you open your testlet with the task-based simulations, do me a favor, look at the topics, do them in the order that's best for you. If you're going to rush on a task-based simulation, rush on something you weren't going to do well in anyway. The first problem you solve in that testlet should be your strongest. The one you're going to leave for last is the one you're weakest in, because if you're going to rush again, let's rush and run out of time on something you probably weren't going to do well in anyway. Your written communications, 3 written communications. Look, you have about 20 minutes or so on average for each of the 4 task-based simulations. On average, about 12 minutes for each written communication, depending upon what it is. But be mindful, one of those task-based simulations, written communication, is also pre-test. Doesn't count towards your score. So do not, God forbid, spend 45 minutes on an individual task-based simulation or 30 minutes on a written communication, and then God forbid it doesn't count towards your score. Next slide, please. Okay, content. As I was mentioning, it's a little bit of everything, but not really a lot of anything. So your corporate governance there, your enterprise risk management, internal controls, business processes, as well as your information technology. That's what I was mentioning earlier. I mean, it's got a good chunk of weight on the exam, 40% or so, but it's mostly, if not exclusively, theory-based terminology, concepts where you don't want to study it in week 1 and then have to restudy it, the week before the exam when you're doing your final review. Let that be on the back end so you study it once, you memorize all that crap, what you need to, and then you're ready to take it exam day and you'll get rewarded for that time and effort. The last thing you want to be doing the week before the exam is scrambling on the math intensive stuff that's going to freak you out, and you can't have that happen. We're going to do the math stuff on the front end. So your cost, your managerial, your corporate finance, the econ, hardest ones in, first ones out. Then you can review your formulas as you're going along. On the back end, you'll do all your theory. But here's the other thing. You can't study something in week 1 and then not review it again until the week before the exam. So let me just explain how this is going to work. If you said to me, Pete, I'm going to be studying a total of 6 weeks for this exam, first 5 weeks is where you're going to be studying the new information. Obviously, we have 5 topics there. You're looking at 5 weeks. Well, you know what? You've got to devote somewhere halfway through to do a cumulative review before you do the second half of the content. You can't study anything new in the 6th week. The week before you actually take the exam, folks, you should be completely in review mode, working your mock exams. In your mock exams, yes, you'll be reinforcing concepts, but your mock exams are really the value is in practicing your timing between the multiple choice, the task-based simulations, and the written communication, nailing down your timing, test at 1, test at 2, etc. The content at that point is all now being reinforced, but you should not be learning anything new the week before that exam, strictly in review mode. Now, look, you're going to see with the dates in a little bit, you know, you have until, I think it's December 15th, the last day to ever take BEC. I don't know why the hell you'd be taking this like, you know, December 1st. I never met a student who said to me, Pete, you know what? I studied too long. I wish I had taken the exam the week before. Everyone who fails over the years that I've been doing and gotten the low 70s or high 60s says, Pete, if I only had one more week, if I only had one more week. So for the most part, you're intent upon getting BEC, depending upon what else you got going on, give yourself more time, but not less. But that last week has to be completely in review mode. Okay, next slide, please. Okay. Sample questions. You guys ready? All right, let me put this up. So you're gonna pass me the baton. So I need you to see you pass me the baton. I'm gonna show you my IT skills now. Watch this, man. Watch my IT skills. Let's go. Uh-oh, where are my IT skills? Come on, man. Uh-oh. Uh-oh.
We see your screen, Pete.
You do? All right, I got to get my big head off there and get my questions up. I think I got to hit escape first. Hold on. All is well. No panicking. Uh-oh. Come on, man. You know, we practice this. Hold on. What? You got to be kidding me.
It's right on your desktop there, BEC webinar PDF.
Oh. No, that's not it. Can you see my desktop?
We sure can.
I can't. I'm afraid if I click this. Oh no, hang on. I promise I will figure it out. It's frozen. Do you have it now?
Yes, we see it. Thank
Let's
you.
Go! Come on, man. Now look, what I just taught you guys is the reason why I do not teach IT. That's right. IT is not for me. And another incentive to get this exam out of the way in 2023 is if you don't like IT because you're like me, get this exam over with, because every section of the exam is going to have built-in IT, no matter what it is, because they want to make sure you know how to work your computer, unlike me. All right, so here we go. So I'm going to show you, I'm going to illustrate some questions, and what I want to do is show you kind of the theory-based versus the math-intensive, and also what we will be doing in our boot camps. It's not about answering this question. Getting this right is incidental. It's using the questions to review the rule in its entirety. So let's take a look. Investment manager says, we're going to prepare an analysis, show the difference between interest rates on U.S. Treasury bonds. Stop right there. When you see that on the exam, what do you think? Risk-free, default risk-free versus corporate bonds. What do we know about corporate bonds? Corporate bonds have risk. They are risky. Both of these bonds, whether it's the U.S. government or the corporate bonds, have the exact same term to maturity. So that's not going to be a difference in the required rates of return because they're both going to mature at the same time. Nor do they have any differences when it comes to marketability. What's a synonym for marketability? Liquidity. So what's going to be the major difference between that corporate bond and that risk-free government bond? The default risk premium. That's nice. But the goal is, again, to use the question to review the rule in its entirety. You guys need to be familiar with the concept of the real risk-free rate. What is that? The pure time value of money based upon what? The supply and demand in loanable funds. Where else does that pop up in the exam? Macroeconomics, money supply, and expansionary monetary policy. The government's on the buy side of government bonds to issue more cash, to increase the money supply, to get interest rates down. Why would they want to do that? To stimulate demand, to get us out of or prevent a recession. So that's your real risk-free rate. Now, your government bonds, your US treasuries, that is a proxy for what's called the nominal risk-free. Your job on the exam is to know if you buy US government bonds, you get compensation number one for the real risk-free, which is really the price we charge for deferring consumption to the future. If I lend you this money, I can't buy this car today. So I want to be reimbursed for deferring consumption to the future. What else do I want to get reimbursed for? Not current, folks. Expected inflation, loss of purchasing power. When you give me my money back in 5 years, 20 years, 30 years, my money's lost purchasing power. I want to be reimbursed for that. A corporate bond is different in that it's going to give you this nominal risk-free rate, but corporate bonds have what? Default risk. So we also want to be compensated for that default risk premium, the risk you're not going to get your money back, which so far US government bonds have never defaulted so far, but I don't know, in my lifetime that may not be the case. So inflation premium, folks, both US government and corporate bonds want to reimburse you for your loss of purchasing power. It's really a lack of liquidity premium. What is a disadvantage of buying illiquid investments? If you want to sell it quickly, it's not marketable. It's not publicly traded. When grandma wants to sell her house, there are not tens of millions of investors worldwide bidding on grandma's house. If she wants to liquidate it quickly, what's she going to have to do? Discount the price. All right, that's a lack of liquidity premium, which we don't have with anything that is generally publicly traded. And then maturity risk. The longer the term to maturity, the more risk you're assuming. What does that do to your required return? Generally increases it. So the longer the term to maturity, you want my money for a longer period of time, I'm going to charge you a higher rate for a loan for 6 years versus a loan for 6 months, despite all other factors are constant. All right, Madeline, you excited? One question down, 5 million to go. All right, by the way, folks, this is the return on corporate bonds. You also need to know the required rate of return on corporate equity. There's two ways of getting that. You could take the return on the long-term bonds and then add an equity risk premium. That's called the build-up approach, or capital asset pricing model. Another way to come up with the required rate of return on corporate stock. Tell me what that nominal risk-free rate is, what we just discussed. Tell me what's called the market risk premium, expected return on the market over the risk-free rate, and then multiply that by the company's beta. That is your single independent variable. Is this stock historically less risky than the market, as risky as the market, or more risky than the market? When beta is less than 1, historically less volatile. When beta equals 1, this corporate stock has about the same level of volatility as the US S&P, a broad equity risk, a broad equity market. And if your beta is greater than 1, historically your stock has been more volatile. Got it? All right, let's do another one. Oh, and by the way, look at the beautiful, detailed, explanatory answers my friends here at UWorld put together. I can tell you right now, there's nothing better than this in the marketplace. They don't just explain why the right answer is right, but why are the wrong answers wrong, and what should you be remembering about those wrong answers? What's the concept that was discussed, which is incredibly valuable? All right, let's try another one. Legalized cheating. You never start here, folks, because I have no idea what to do with this information. So what are you going to do? You always start the question stem. This way you don't have to reread the facts. They want me to calculate weighted average cost of capital. Stop right there. I'm thinking, how did I raise the capital to buy my assets? I need my weighting. We first look at, when you need your weighting, your target weights. If they don't give you target, it'll be fair market value weighted. So I'm looking for my weighting. I see a debt to equity of 0.8. So on the exam, you're ready. You take your debt, divided by your equity. And you're saying, but Pete, they didn't tell me my liabilities or my equity. Well, kind of, sort of. This is what you're going to do. Make up an easy number for the denominator. Always make your equity 10. 10 times 0.8, what's your debt then? 8. You now have your capital structure. Your equity is 10, your debt is 8. The sum of the two is 18. 8 divided by 18, 44% of your capital came from liabilities. 10 divided by 18, approximately 56% came from equity. And now the theory questions, folks. Is this good or bad? A high debt to equity, is that good or bad? Well, when you got a lot of debt, you've got a lot more risk that you will not be able to pay your debt as it becomes due. That's the bad news. Is there any good news? You bet. Net income divided by equity, your return on equity. When you started your business, you didn't add a lot of partners, you borrowed the money. So if you're successful, you're going to have a higher return on equity. More risk assumed, higher expected rate of return. Debt to equity, a low debt, a high equity. Is that good news or bad news? From a risk perspective, hey, you've got a hell of a lot less debt. We know equity, dividends are not legally required, not even on preferred stock. Even though there's a fixed rate, those dividends are not legally required. They have to be declared at the discretion of the board. So it totally mitigates the risk of financial distress. That's the good news. The bad news is, damn, you got a lot of partners. And if you got a lot of partners to share that return with, what's going to happen to your return on equity? It's going to go down. So you got to understand the pros and cons of different capital structures. Okay, what's a major advantage of borrowing money? The government subsidizes the cost of debt. How do they subsidize that cost of debt? By giving you a tax deduction for the interest that's called the interest tax shield. So when they tell you your tax rate is 40%, the government's picking up 40% of that cost. So what's our share of the cost? 60%. What is our after-tax cost of debt? 4.8. Take a percentage, multiply it by a decimal. That is approximately 2.1. What is our cost of equity? 20%. How did they get that? I don't know. Maybe that build-up approach. The pre-tax yield on the long-term debt plus an equity risk premium, or maybe the capital asset pricing model. So we multiply that by 0.20. The weighted cost of equity, 11.2. Sum of the two, 13.3. Now, if you're religious, you'll pray. I hope that's an answer choice. And whoop, there it is. Come on, man. You kidding me? Now, that's just part of the picture. Folks, why are we learning about weighted average cost of capital? WACC is your hurdle rate when you make an investment, your hurdle rate for projects of typical risk, average risk, typical, or average risk. Okay, folks? When you make an investment, if you're using the internal rate of return methodology, we want to get an IRR greater than our hurdle rate. That's a project we will accept. Or I want a project where the sum of the present value, the future cash flows, is greater than today's cost. How do you get the present value? WACC is your discount rate for those future cash flows. What are the future cash flows? We're going to have two future cash flows. Your operating cash flow, your EBIT times 1 minus the tax rate, plus your depreciation times the tax rate, and then your one-time terminal year cash flow, which is your proceeds on sale when you liquidate that investment, net of tax. You will discount those future cash flows at that WACC, that hurdle rate. Now look, when I do that boot camp with you, we're going to be connecting the dots. I'm going to show you these concepts in one question, and then we'll apply it in another. That's how you reinforce the knowledge. And look, the more senses you engage when you study, the more likely it is you're going to remember it. So watching me do it is great, but it's like working out. If you watch me on the treadmill, is that going to do anything for you? I don't think so. So you're going to put the pen to the paper. And if you want to take the boot camp and you want to get something out of it, you're going to be making flashcards with me. Because what you write, you will. Did you ever do cheat notes? I know Madeline told me she did a lot of cheat notes in grammar school, and that's how she got through school, high school, college, she made her cheat notes. But the good news is when you write something, because you're taking the time to write it, you're more likely going to remember it. And not only are you going to write it, folks, you're going to speak it. Whoever you're dating, first of all, you need to get rid of them because they're an impediment to your success. They're distracting you. But if you insist on staying with them, make sure they're your soulmate. Talk to them about weighted average cost of capital. During dinner, And if they're still there at the end of dinner, not only do you going to learn about whack because you spoke about it, you also confirm that that's your soulmate. All righty. They also might have some challenges if they actually found that conversation interesting. Damn COVID is killing me. I got my COVID. All right, you guys ready for another one? Guys ready? Madeline, are you ready? Madeline, talk to me, man.
Pete, you're not alone here. You're doing awesome. And yes, totally ready.
All right, you
And
are
I never
not
cheated in grade school.
I am here with you. Yes. All right, here we go. You ready? Where are we going to start with this question? Not with black ink, because I have no idea what to do with all that information in black ink. Where are we going to start? I want to know what's the total cost for my June 30 work in process, started but not finished. When you see work in process, you think started and not finished. So let me read my facts. We have the weighted average method in a process costing system. We are mass producing homogeneous units. Remember that? Mass production of homogeneous units. What the hell is that weighted average method? Oh yeah, forget this question. If we were doing our boot camp, I'm going to stop and say, hey, do you know how to calculate what was given information here? These costs per unit, how the hell do you come up with a cost per unit? Well, if you're doing the weighted average method, first thing we need is equivalent units. Tell me what was completed that period, okay, times 100%. Tell me what's in ending inventory times the percent complete. The sum of those two, that's your equivalent units. Step one is complete. Step two, beginning costs plus your current costs divided by those equivalent units from step one. There is your cost per unit. Now look, in this question, we were generous. We gave that to you. All righty. You've got to do this for two things: materials and what's called conversion costs. What the hell is a conversion cost? Conversion costs are your direct labor plus your manufacturing overhead applied. And then I'm thinking, hey, I remember, what's a prime cost? Oh yeah, that's your direct materials and your direct labor. You got to know your terminology inside and out. Easy points exam day. Get it right quickly. All right, so let's see what we got. We got 40,000 units that we've started, but we haven't finished. They're 100% complete with respect to materials. All righty, so my materials, 100% complete, 40,000 units times 100% complete. So the equivalent units for the materials, 40,000. Okay, what is my cost per unit for the material? $5. Cost per unit for the materials, 40,000 times 5, that's $200,000. But what about my conversion costs? Those 40,000 units are not done yet. We added the materials at the beginning of the process, but we haven't finished putting it all together. They tell me those units are what? 60% complete with respect to the conversion costs. 60% of 40,000, that's the equivalent of having 24,000 finished units. What's my cost per unit for the conversion costs? $7. 7 times your 24,000, 168,000. Add it together, $368,000. Therein lies your total cost for the work in process, okay? You've got to know what's called the weighted average method. Had they not given you that cost per unit of $5 for the materials, of $7 for the conversion cost, you got to be able to do that for yourself. And the way you'll do it is the way it's explained there. Now, you might be thinking, Pete, is weighted average the only thing they could test? No. There might be FIFO, first one's in, first one's out. How do you calculate equivalent units under FIFO? Beginning inventory times 1 minus the percent already complete. How much work did we have to do this period to finish it? Then the units that are started and completed this period, the units that are completed minus what's in beginning inventory. And then you take your ending inventory times the percent those are completed. Add that all up. There's your equivalent units. Step 1 is complete. You then take current costs only with FIFO. It's current costs only. Divide that by equivalent units, and therein lies your cost per unit if we were doing what methodology? FIFO. All right, so look, when you practice questions, again, getting that question correct is actually incidental in the process. The goal, again, is to use the question to review the rule in its entirety. And then on the boot camps, obviously, I will do questions that illustrate that. All righty. Let's try one more theory question. You ready? Short, sweet. Let's start at the top. Not much to it. We got a linear regression. What is that? Well, a simple linear regression, we have one independent variable. One independent variable. Multiple linear regression, you have more than one independent variable, more than one. All righty. Unless they tell you otherwise, we're dealing with simple regression. Where do we use that? Total cost is a function of what? Total fixed cost plus your variable cost per unit times your output. This is also known as Y equals A plus BX, where A is your Y-intercept. Your total costs when there's no activity. B is your slope, your change in your dependent variable divided by your change in your independent variable. All righty. So our variable cost per unit, our single independent variable is our output. Our single independent variable is our output. So folks, they tell us in this question, we've got an intercept value. Total fixed costs are $322,897. So how should we interpret that? Well, my total costs would equal my total fixed cost of $322,897 if my output is what? 0. If I don't produce anything, then my total cost equals my total fixed cost. In the short term, those fixed costs are not avoidable. You sign the lease, you got to pay the rent, whether you produce or not. So folks, Y, your total cost, has a value of $322,897. Your total cost is going to equal that total fixed cost when your output is what? 0. All right. Now, what does that look like in terms of a chart? Not that you have to draw it, but you got to interpret it. Folks, in this example, $322,897. This is my total fixed cost, whether I produce no units or whatever your relevant range is, 1,000 units, whatever. That is your total fixed cost. Okay, that's your Y-intercept. This range here, this line is your total cost line. Here's my total variable cost, which is a function of my variable cost per unit times my output. My dependent variable, dollars. All righty. So your total variable cost is a function of variable cost per unit times your output. Okay, now what if I put another line in here? Check this out. Watch my skills. Watch my skills. Can I do it? Shit, look at that. I'm changing colors, man. I'm a tech expert. That's your sales line. Your sales line always has a Y-intercept of what? 0. To the right of your break-even point, which is right here where your sales equal your total cost, that's your break-even point. This is the number of units you need to just break even. You don't have that number of units, you got a loss. You hit that number of units, you can break even. To the right of that, you got a profit, right? How do you get your slope? How do you get your slope, your variable cost per unit? That is a function of your change in your dependent variable given the change in your independent variable. What does that look like in a regression model? Here's your independent variable. Here's your dependent variable. There's the change in my independent variable. There's the change in my dependent. Change in the dependent relative to the change in your independent. Therein lies your slope. Your sensitivity to changes in output, production volume. All righty, more to come on that. Now, you might be saying to me, Pete, but I want to do a task-based simulation. Hell yeah. In our boot camp, we're going to be doing a task-based simulation because far too many people spend all their time on multiple choice and say, oh, I'll worry about the task-based simulations when I get there. Absolutely not. Folks, even if this were an open book test, the task-based simulations are challenging, not only because of the subject matter, but because of the volume of information. You've got to have an approach that you've practiced on how you're going to attack these things. So folks, legalize cheating again. You're going to look at your various problems, and as I mentioned earlier, your easiest ones, whatever's easiest for you, you do first. Anything you're not as strong on, you do last, because again, if you're going to rush and run out of time, which is not going to happen to you because you're going to be properly prepared, but if you do rush on something that's not your strength. Okay, so here's a task-based simulation, an illustration, part of our boot camp. You ready? They tell us Birch Corp is a floral retailer in the US. The company is interested in improving its working capital. Stop right there. How do you improve your working capital? They want to reduce their risk of short-term distress. They want to make sure they have enough current assets to pay their current liabilities as they become due. So folks, what are they looking to do? Any combination of reducing their current assets and or increasing their current liabilities, decreasing their current liabilities so they can increase their working capital, reduce their risk of distress. Okay, I want to know, what do they want me to do? Task number 1, toward the end of year 4, the company's finance manager, reasonable level of cash that they should borrow and maintain working capital. You've got to review their options set forth in the working capital alternatives memorandum, and we want to determine the impact of each strategy on the company's working capital. So the first thing is they're going to do a bunch of different things, and we've got to determine, hey, is this going to improve working capital? Will the increase in current assets exceed the increase, if any, in current liabilities so that your working capital is up? All righty, what exhibits do we have to look at? Working capital alternatives memorandum and the accounts receivable aging schedule. So those 2 exhibits are for task number 1. I want to make sure what I'm using each one for. But now before I do anything there, let me just see what else there is to do here. The second task, there's only 2. They tell us we got shareholders equity of 10,380,000, long-term liability 7,005,000, net working capital excluding receivables 2,105,000, non-current assets 15,190,000. They want to know, what's the accounts receivable? Stop right there. They want to make sure you understand fundamentals of financial accounting or cost accounting. Hey, your capital, how did you raise your money? What combination of debt and equity? So folks, they just told me we have shareholders equity of 10,380,000. The company's, I don't know my current liabilities, but I do know my long-term 7,005,000. Okay, so I don't know my current liabilities, but I do know my long-term is 7,005,000. They tell me non-current assets, I don't know my current assets, but I do know my non-current assets, 15,190,000. The left-hand side of this equation's got to equal the right-hand side of this equation. All righty, so what we're going to have to do there is use what information? Well, they tell us we have to figure out what our accounts receivable is. So here are my exhibits. Working capital memorandum, accounts receivable aging. Okay, that's both for task 1. So we've seen both tasks. We know what's involved. We kind of got it set up. Now let's answer it. You ready? Term loan, option number 1. Well, what the hell is that? What's going to happen? So let me see. Term loan, option 1. Well, they tell us any activity we do is going to take place on December 31st, year 4. Again, the goal, current assets up and or current liabilities down to get working capital up. Why am I screaming at you guys? I only have one volume loud. I'm sorry for screaming at you guys. But term loan, option number 1, you ready? A 2-year loan, 240,000. Amortize, what the hell does amortize mean? We're gonna pay off the principal, equal amounts every month for the next 24 months. So folks, I'm gonna borrow $24,000. Cash is gonna go up by $24,000. Since I'm amortizing that over a 2-year period, how much principal has to be repaid within the next year? 129,000. I'm making up my own numbers. Half of the 240, 120,000. So current assets are going to be up by 240, not 24. That would be 240,000. Cash is up. Current liabilities are going to be up as well, but only by 120,000. Long term, any principal due beyond the next year, 120. So folks, that'll improve my working capital. Working capital will be up by a net 120. Next one, A 2-year term loan, 240. Interest only payments, I like that. All the principal will be repaid 2 years from now. So now cash goes up by 240,000. So current assets are up. Current liabilities, no change. Long term is going to go up by 240,000. So for this one, working capital's up by 240. We're kicking ass because all that obligation is going to be paid on the back end. Line of credit, 240,000. How much are we going to draw though? The first payment is going to be due end of January, year 5. Within a year, let's see, the company's going to draw 50%. So this is all going to be done December 31st, year 4. They're going to take 240,000, draw 50%. Cash is going to go up by 120. They tell me, let's see, the company's going to draw 50% of the full amount with repayment due at the end of the 12-month period. So this ain't going to do nothing for me. Current assets are going to be up, but current liabilities are going to be up by 120 because that's got to be paid at the end of the year. So working capital here, no change. All righty, factoring agreement. We got to factor receivables. They tell me my receivables here. Let's see. We can factor receivables on a non-recourse basis, which means don't come back to me when I sell it to you. Factor. I got no further obligation. It's your problem to collect. I got no future obligation. Problem is I ain't getting all my money. The factor's taking 12% right up front. That's the cost of this factoring. The discount is going to be the cost of this arrangement. So we're doing this for all the balances that are less than 61 days, less than 61. So folks, everything to the right there is 61 or more. Okay, so we want less than 61. So that means 309.33 plus 24,300. How much accounts receivable are going to be factored? That's $333,333. But are we collecting all that? Unfortunately, we are not. $333,333 times 1 minus the 12%, the fee. How much are we actually going to walk away with? We're going to walk away with $293,333. Okay, we're selling our receivables, so we don't have to pay anything back. There's no loan here. There's no change to current liabilities. So what's happening here? Cash just went up by 293,333, but accounts receivable just went down by how much? $333,333. What happened to the other 40,000? That's your cost of factoring this. You ain't getting that money. So folks, your net change to current assets minus 40,000, current liabilities no change. But instead of having a receivable of 333,333, you want your money now, you ain't getting 100%, you're getting 88%. The 40,000 is your cost of factoring. So your net change to current assets there is down by $40,000. So that's not a good thing to do. How about sale of delivery trucks? The company can sell 5 vehicles, non-current assets. For how much? 100,000. Non-current assets is going to go down by the net book value. The book value, your original cost minus your accumulated depreciation, your net book value, cost minus accumulated depreciation. So non-current assets are going to go down, but I don't know the net book value. It's irrelevant. I just know I'm going to get cash of $100,000. I don't have to repay anything. So current assets are going to be up by a plus 100, current liabilities, no change, all set up. Beautiful. So then you would go and answer that task number 1. It's all set up. Do me a favor. Look, when you click on each one of these, it'll tell you what your potential answer choices are. Don't rely upon that because they're going to try to bait you into the second best answer. I already know the answers to every one of these because I set it up. I don't click on the blue box to then give me all these choices that now I'm haggling between the choices. No, now I'm just choosing, like for let's see, term loan number 1, which has current liabilities up by 120. Current liabilities, no change. Let's see. Excuse me, current assets up by 240, current liabilities up by 120. Which answer choice has? Let's see. Current assets up by and I can't see this. Let me move this over. Uh-oh, I didn't want to do that. Did my head just pop up again? No, I don't want that. Did my head just, oh, there we go. Okay. So folks, we're looking for current assets up by 240, not 120. Current assets will increase by 240. Current liabilities 120. There you go. There it is. All right. And then you'll pick each and every one. Folks, task number 2, real quick. I'm sorry, is my head popping up again? Oh, you know what? We're going to make task number 2 your homework question, your thriller to keep you excited. Uh-oh. Madeline, am I still there? Or did I shut you guys off?
No, you're still here, Pete, but you did have some fun windows popping up there.
Oh, I'm sorry about that. And real quick, guys, so I answered task number 1. Let me just show you task number 2. You ready? We already have it set up. And we have our detailed explanatory answer here, but I don't want to leave you guys hanging because I know you're very excited to learn what that accounts receivable must be. And I want to show you the technique. So for task number 2, you ready? What did they tell us about the right-hand side of the equation? I don't know what current liabilities are. What did they tell me though? They tell me our accounts receivable balance, we don't know, but we do know this. The company's long-term liabilities, we got net working capital excluding accounts receivable. What's net working capital? Current assets minus current liabilities, excluding accounts receivable, which is what we're looking for. That number is what amount? 2,105,000. Folks, I want to show you something. Notice how I dropped the zeros. It is very helpful, folks, when you drop the zeros. Why is it so helpful to drop the zeros? Because if you have to input into a calculator, you won't waste unnecessary time. Now take a look. I don't know what current liabilities are on the right-hand side of the equation. I don't know what current liabilities are on the left-hand side, but it doesn't matter because they're going to cancel each other out. So when we solve for the left-hand side being equal to the right-hand side, current liabilities are a moot point because they're going to cancel each other out. We don't know the number, so just make it a 0. All right, so now let's do this. Total capital minus the current liabilities. What does that add up to be? The total capital excluding the current liabilities. That works out to be, I got 17,880. That's the right-hand side of the equation. Isn't that right? Okay, what else do we know? Our current assets plus our non-current assets have to equal 17,880. I know that my non-current assets are 15,190. Agreed? We know that was given information, 15,190. So folks, what we want to do then, you ready? What are we missing? What's this piece of the puzzle got to be? If you take your 17,880 and you subtract your 15,190, we know what we're missing. All right, so our net working capital, current assets, minus current liabilities, minus accounts receivable. We're making this a 0. We know this number is 2105. We know that number is 2105. Agreed? Okay. So what does that missing piece of the puzzle have to be such that total assets are 17,880? 17,880 minus 15,190. I got that to be 2690. That's what the left-hand side has to be, 2690. If that's got to be 2690 and I'm excluding my current liabilities, what does accounts receivable have to be? 2690 minus your 2105, that's got to be how much? 585. Then check yourself. 585 plus 15,190. 17,880. But that's not really my current assets. That's my net working capital. Okay. Oh, excuse me, my accounts receivable backing into. So that missing piece of the puzzle got to be 585. All righty. So my accounts receivable, and let me just make that 585, has got to be my accounts receivable. So if you were to break down all of your current assets, your cash, your marketable securities, your accounts receivable, your inventory, your prepaids, all of your current assets, minus your current liabilities, your net working capital is 2105. We're going to make current liabilities zero. We're going to make current liabilities zero. All righty. So my net working capital given information helps us back into, they love those questions where you have to solve for missing pieces of the puzzle. So your job, and this is just fundamentals of financial accounting, is to understand how your total capital is raised. What combination of debt and equity? Folks, remember, current assets, when you have a lot of current assets, you have less risk of financial distress, but your return on capital tends to be lower. When your non-current assets are higher, you're less liquid. When you're less liquid, your risk of distress goes up, but what kind of return do you get on non-current assets? You get a higher return on capital. Oh my goodness, I promised 3 minutes for questions. Madeline, do you see that? I gave exactly 3 minutes. Let's go.
Let's go. All right, we actually have a couple more slides. We can run through them really fast.
Oh, yeah, put them up, Madeline, put them up. I want to show the dates. Yep.
Yep, I know they're important. Hoping you can see my screen.
Okay, guys, if you're serious about taking BEC, very important deadlines. Depending upon the state you're in, your deadline can be in just a couple of weeks, as early as September 17th to register. First-time candidates, meaning you haven't sat for BEC before. But if you are in other states other than Arizona and Texas, you might be October 1st. So what's your assignment today? Check with your state board of accountancy. What is your enrollment deadline for BEC for you to take it in 2023? Now, re-exam candidates, we're talking about you've taken BEC before. Re-exam candidates, let's see, September 17th. For everybody else, that could be as late as November 12th. So the key thing is to make sure in your state, you know what your specific registration deadline is, depending upon whether you're a first-time candidate or you're re-exam, retaking. Folks, the last day to take the exam itself is December 15th, folks. You know that notice to schedule. You know, in major cities, there's going to be a log jam of people looking to take that exam towards the middle of December, close to December 15th. So the earlier you can schedule, the more likely it is you can get the date you want. Okay, so jump on those dates so you don't screw something up. Go ahead, Madeline, next one. All righty, so folks, the point of all this is to show you, as I mentioned, where most students waste a lot of time, unfortunately, is spinning their wheels on the math-intensive topics. What we can do for you to help you better prepare is that we can handle the math-intensive topics with you, the cost, the managerial, the corporate finance, a lot of the econ. We're going to have a boot camp, and to sample, well, what's that going to really be like? Instead of this short 30-minute sample, we're going to have a 1-hour Saturday, September 9th, free of charge. There's your QR code to register, where all I'm going to do for an hour is work the math-intensive problems, some theory mixed in like I did today, but predominantly topics that people struggle with. If I can help you get through that faster, then you'll have more time for you to master the IT, the corporate finance, the corporate governance, the enterprise risk management, okay? So a little sample September 9th. Then what we'll be doing after that is we're going to have scheduled dates to be determined 3-hour intensive reviews where we'll be then going through, a lot more problems, okay? But September 9th is totally for free. Our goal is to earn your business. We want to show you what we're going to be doing, how we're going to be doing it, so that you guys can say, hey, this is going to be a good use of my time. Madeline, anything I'm leaving out? Oh, yes. All righty, folks. Your university, your firm, a lot of firms have people up for manager who can't get promoted because they don't have the exam, or you may be at a school where you're studying collectively with a lot of other people. UWorld obviously offers volume discounts, so you're enrolled together at your school or your firm. We are happy to put that together for you. So this is the QR code for that. That'll just connect you with someone at UWorld to say, hey, the folks at my school or my firm, we want an in-house boot camp. or we want to whatever, what you want the course, whatever it is we could do to help you guys. That's obviously what we're looking to do. So that's for you all to contact us if you want to put together something for your firm or school. What else we got, Madeline?
All right, so we are a little bit over time right now, but if anybody wants to stick around, and Pete, you have just a couple minutes, we can answer
Absolutely.
a few questions.
Yep.
Okay, great. I'm going to answer a couple real fast too, because we've seen a lot come in asking about the 2024 course content. Note that our course will be updated to incorporate 2024 this fall. It's coming soon. Make sure that you are following us on social, that you're connected with us on email, and if anyone is already signed up in the course right now with current access to 23, then you will have the automatic access to 2024 as well. So there's no reason to wait. And also noting that the 2024 material will include our friend here, Peter Olinto, the wonderful Roger Phillip, and the rest of our fantastic team of CPA educators, accounting educators, CPA practitioners. So please be on the lookout for that. The team's been working really hard and it's going to be great. The other question that I keep seeing is, will this be recorded? Yes, it will. Yes, it has been recorded, and we will send out the recording afterwards. Okay, Pete, to you. Will Pete buy a cup of coffee for anyone passing BEC?
Hell yeah, you know. Now, wait a second. Just one part? Then
That's the question.
Equivalent units. You get a quarter of a cup of coffee.
Perfect. Great. Okay. How soon can someone be ready to take BEC? How long does studying take for this section?
You know, so like I said, 100 hours, but look, I don't think you're going to study more than 8 hours a day. So, you know, if 2 to 3 weeks would be very ambitious, but that's assuming you're a recent college grad, you did really well in cost, managerial, corporate finance, econ. I mean, yeah, we have students that can knock out BEC in less than a month. I mean, but you got to be, recent college grad and have done really well in school so that truly this is a review for you because it's relatively fresh in your mind and you did really well in school. But that's a rare exception to the rule. That's probably like in that bell curve I mentioned, maybe the top 5% of students. 95% of us folks are probably going to have to study for this in 5 or 6 weeks, I think is realistic. I mean, if you could give me 2 months, obviously your passing rate can be regressed against the time and effort you put in. So the more time, the higher the probability goes up. The less time, the lower the probability. So I'm going to say no less than 3 weeks. Recent grad, A in cost, A in managerial, A in corporate finance. You did well in econ as well. Anybody else, you should be looking to give yourself, 5 or 6 weeks at a minimum.
Great. Thank you. Okay, here's another one. If someone is concerned about language, what section should they take instead for the disciplines?
Yeah, so if you want to avoid the written communication, then it depends where you are. If you're sitting for the CPA exam for the very first time, that 18-month window you have is kind of not exactly accurate, because you could take as much time as you want for your very first part, because that window doesn't start to close until you've passed your first part. So, normally, historically, what I would tell people is, well, hardest one in, first one out. What's generally the most challenging for most students is probably financial because of the volume of information, right? And then what I would tell students is the part you sit for last should generally be what you're going to do for a living, because they want to make the exam more practitioner based. So if you have experience in audit or tax, those parts of the exam would be progressively easier as you have work experience and training. So normally I suggest financial on the front end and then either audit or tax on the back end, depending upon what you do for a living. And that's if you're looking to avoid the written communications. However, with that being said, as I mentioned, if you haven't even started yet, you might want to think about taking financial in 2024. You could start studying now, but if you take it in 2024, there's going to be a lot less information on the financial core than the current financial section in 2023. But yeah, I would jump in as soon as possible to start studying. But you can also contact us offline if you have any more questions, but that would be my advice, Madeline.
Great, thank you. All right, here's a good one. What are the topics that they usually test on the writing portion, and what's the best way to practice it?
Yeah, so the writing portion can really be, I mean, it's got to be CPA content related, but it doesn't have to be BEC specific. It could be, but it doesn't have to be. You know, it's not graded. I mean, believe it or not, a lot of this is actually machine graded. So it's not even about, the content per se. It's about the writing style, the grammar, the punctuation that you can communicate. Look, when the US CPA exam went international, we have a lot of candidates around the world sitting for the US CPA, where, as I mentioned, English may not be their first language. They want to make sure, hey, there's a certain standard for communicating, and they're getting rid of this, but historically that's what it was. So it's not a heavy lift for US students. You're basically going to look at how we set up our detailed explanatory answers. Maybe you'll practice a couple where actually you write them out, but for the most part, by just looking at the way we set them up, you'll get a good flavor for how it works. But as I mentioned, it's not about regurgitating rules. It's not like in college where your professor might ask you, hey, what's what are the requirements to have a legally enforceable agreement? And then you got to write out, what the elements of a contract are. It's not about that. It's about the writing style, the punctuation, the grammar, that kind of stuff.
Okay. Well, I think that actually covers the bulk of our questions. And I just want to thank everybody for joining us. And thank you, Peter Olinto, for this excellent webinar. And we hope everyone joins us for the live BEC Boot Camp coming soon.
Saturday, September 9th, 10 a.m. Central. Put it on your calendar. I want to see you there. We will not waste your time. We will make it worth your while. You're going to thank yourself that you gave us that hour, and it's for free. So you got nothing to lose. See you then.
Great. Thank you all.
Thanks, guys.